Hey everybody, this is your boy Mikey. Welcome to another episode of Option Trades in the News. Today, we'll be looking at what's happening with the US debt ceiling and considering a potential option trade that can bring in some bank if all this political theater plays out exactly like we think it's going to. We'll be taking a step-by-step look at a credit option spread, why we would consider that strategy, and how we would actually execute it. So stick around. It's going to be great. But first, let me pour myself a drink. So for those of us that need the details, here's a situation of what's going on with the US debt crisis, why it's a big deal with a big deadline. By the way, don't forget to subscribe and like my channel. If you enjoy weekly discussion on option trades that we see in the news, it'll help the channel grow and keep the discussion going. But hey, let's get to it. So in January 2023, the US government hit its borrowing limit. In other words, we've reached a debt ceiling, which is $31.4 trillion, and it needs to be raised so we can borrow more money and keep the country running. Under the US Constitution, only Congress is authorized to set the amount that the US can borrow, and this is done through a vote. And this, of course, is where the political theater comes in. While it's true that the ruling Democrats are in control of the Senate, Republicans now have a majority in the House of Representatives, and as a result are currently refusing to discuss raising the debt ceiling until certain concessions are made on what they call irresponsible spending. Not surprisingly, this is creating a political gridlock of Democrats versus Republicans, with President Biden stating that raising the debt ceiling is non-negotiable. Most of us might know that this is not a unique story. In fact, in 2011, under President Obama, when Democrats and Republicans were again caught in this political deadlock about increasing the debt limit to Congress, but back then, a deal was made to raise the limit just 2 days before the expected date of default. This created a lot of panic and stress and also caused the U.S. to get its first downgrade of credit ever in the history of the country. The fact is, in the history of the United States, the country has never ever missed a debt payment or defaulted on any of its debts. And if this were to happen, the ripple effect across the global financial markets would be enormous. It goes without saying, there's no real benefit to America to allow this to happen. Now, we all know that the politicians will play a game of chicken, squabble, bicker, and debate right up until the default deadline. That date happens to be June 5th, by the way. This still gives us a couple of months to make a pretty interesting play on things that we think are going to happen. So what can we see happening as we get closer to the deadline? Simple, panic. And when panic happens in a case like this, you're almost definitely going to see a surge in the gold markets. Now, gold as a hedge against the American currency has been pretty loose in the last few years, but in very extreme situations, you absolutely see a move to gold and the price of gold go up. Now, a great way to invest in gold without actually getting into the futures markets or buying gold directly is through the SPDR ETF, ticker GLD. Now, this is an ETF that tracks the price of gold, and it allows us to do a lot of option trading on it, so it's a great choice. Now let's have a look back in 2011 when we were also having a similar debt crisis. So as you can see, as we got closer and closer to the deadline, the price of gold began going higher and higher, which is understandable because naturally a sense of panic would set in for the reasons we talked about earlier. Something very, very similar is likely to play out this time. Now, when deciding to make an investment decision on a particular event, two good parameters to look at are probability and impact. And I think we can all agree that the probability of political quagmire drawing the process out and creating a panic in the markets is pretty high. On the other side, the impact of providing distress to the markets because of all the uncertainty, which is a result of the political squabbling, is also pretty big. You put these two together, and that makes this event a pretty good one to look at. So let's get to work. Essentially, what we're going to be doing is a put option credit spread. It's sometimes called a bull put spread. Bunch of different names out there. We just need to realize it's a pretty basic option trade if we take it step by step. Little recap. We know that the price of gold, and as a result, the price of GLD, is expected to go up because of uncertainty and panic as we get closer and closer to the debt ceiling deadline. In response to this, here's an option play we might consider. We're going to sell a put option that's out of the money and then buy another put option that's even more out of the money. Now you should know that the put option we're selling, because it's closer to the action, it has more potential because of the higher strike price, would be worth more than the one that we're actually buying, which is further away from the action. So if we buy the lower put option and we sell the higher put option at the same time, there's going to be a net deposit into our account. The plan is to execute this buy and sell simultaneously, which is what a credit spread would be in this case, and wait for both options to expire, which we fully expect because of the political debacle that is almost guaranteed to be coming in the next few months. When both options expire worthless, the net credit will be deposited into our account, and that then becomes 100% profit to us. All we have to do is find two suitable options to do the credit spread, execute, watch classic politics unfold, and then let the options expire and make bank. So, let's go find some options. So let's go see if we can find some options that's worth our time. Yahoo Finance is one of the simple sites I use. I like it, clean, simple. But let's pull up what we're looking for. As we can see, the share price is in a 173 range. We're going to look for some options. A whole bunch of choices to make here. We know the magic time is around June, but for our purposes, I'm going to go 1 month out, right? So as of the making of this video, I'm just going to go a little over 1 month out and see if I can find anything. I can go later if I want or not. There's actually an art to it. So for March 17th's expiration, let's go find some puts. And of course, we're looking for stuff that's out of the money. This is where you have to make a decision. How strongly do you feel the share price of GLD would not touch before the options expired? We expect it to stay up and keep going up, but nothing goes in a straight line. There could be a little bit of pullback and rise. You have to make that decision. How far away do you want it to be? If you try to go too far away, as you can see, the option prices don't differ that much. So let's take an example. I was considering selling a put option at strike price 165 and buying a put option at strike price 163. As we know, selling this would give me $54 in my account, but buying this would cost me $34. So I'm looking at a $20 deposit show up as a credit in my trading account. Now let's pretend we're just doing one option selling here, one option buying here. We know one option controls a contract of 100 shares. However, because I'm selling at 165 and buying at 163, there's a $2 gap. There's a $2 gap, and as a result, I would have to keep 100 times 2, which is $200, on reserve in my trading account while I'm executing this strategy. In other words, I have to make $200 available, and if everything goes as planned, which we expect it to, I'll get $20 deposited in there. Is this pretty small? Yeah. So why not get more spreads? 3, 4, 5 spreads. But let's look at it on a one-for-one basis first. So remember, we're selling that higher price call option. In this case, it was strike 165. We're expecting to pay about $54 for that. We're going to go ahead and buy that lower strike put option, which was at strike 63, which would cost us about $34. The net of that would be a gain of $20. If all goes as we expect and these two options expire worthless, which is going to happen significantly before the June deadline, that $20 deposit would actually become profit for us. Now, as was mentioned before, we can do 2 spreads, 4 spreads, 5 spreads. But remember, for every spread that you do, you have to reserve $200 in your account as a sort of insurance, because from 163 to 165, there's a little bit of exposure there. And as a result, you'd have to leave $200 as a deposit for every credit spread in this scenario. So you can get one spread or multiple spreads, but the assessment of this should stay the same. Simply put, we locked up $200 for about 1 month to make $20. That's a 10% return on investment. Now, remember, we could scale that up, but let's just look at the simple numbers here. We made 10% on our money in 30 days. That works out to an annual rate of over 85%. Bank certificates right now are offering around 4 to 4.5% for an entire year. So I hope that puts things in context. So what's the summary? We know that the US debt ceiling crisis is going to get worse and worse. As a result, the price of gold is going to go up, creating an opportunity for a nice bit of profit on a put option credit spread. Now, there are many other techniques we can use here, but this is a low cost, reasonably low risk strategy and is almost definitely going to play out based on what we know politicians are going to do. Guys, it's been a slice. Thanks for joining me on the channel this week. Please remember to like, subscribe, and share the video to help the channel grow. Take care of yourself, be good to yourself, and I'll see you next week.